There are quite a few things online that you'll see and hear that are going to kill you. And one of those things is day trading. And I'm going to lay into day trading today because I'm so sick of people online pushing this narrative to only hurt you. My goal is to educate you in every single component of finance. And so you can choose specifically the route you want to take. But the reason I don't push any day trading is for good reason, because the data says that you're going to lose. And if 1% of people are successful and those people are on Wall Street, which I'm already starting to break down facts, by the way, you're not having any success with day trading, and nor should you be putting your financial future in day trading that gives you a 1% success rate, which those 1% success rates are on Wall Street. And by the way, they're not people, they're billion-dollar algorithms. So Joey, if you're in your parents' basement right now, or Jack, if you're on college campuses and you're using your TD Ameritrade account and you think that you're winning because you're following some guru online with a chart that looks at candlesticks, you aren't that smart, and you need to listen to me, because I am going to help you and unlock you to build real wealth. There's a reason I talk about the fundamentals of wealth building. And the reason they call me the Tim Duncan of finance, for any of my NBA fans out there, is because he is Mr. Fundamental. The roadmap to financial freedom, a millionaire's guide to building automated wealth. I have a hard time seeing and hearing the things I see online and on TikTok specifically, or Instagram, because I know what it does to you. I know what it does to the average person. I want to help you. My whole goal is to help you, not hurt you. So when I see this stuff, I just know that a novice not listening to my stuff, but listening to everything they see on TikTok, is going to be allured by the screenshots that these traders will post. And there is no chance that a 17-year-old or 18-year-old or 19-year-old is getting real results. And I'll break down the numbers for you so that you can come to the own conclusion. So let's just start here. Market performance. There's a lot of data I'm going to share today, guys. So buckle up. The percentage of American stock traders has increased from 15% in 2019 to 25% in 2021, and that continued to grow into 2022 and obviously into today. It's an amazing thing to see people excited about investing. Like, that's such an exciting thing. And a lot of it was spurred by COVID, everyone being home, everyone being on their phones. But then a lot of this stuff, these, specifically these traders or these brokerage accounts, were open for the wrong reasons. So if I take a knife and I go stab somebody, that's probably not the best thing to use the knife for. It could be used for that, but my goal is to use that knife to probably slice some bread, to cut some meat, whatever the case is, right? And if I use it as such, I'm going to get really good results and it's going to be worthwhile. But if I'm using this tool, a brokerage account in this example, to then trade, I know that I'm going to lose, which then therefore the tool isn't really that helpful. Get my point? So let's look at the stock market performance for quite some time. So first off, let's understand that the S&P 500 is not the entire market, but it's very representative of the market. And most people will benchmark the results to the S&P 500 for good reason, because it's the largest 500 US companies that we have at any given point in time. So there's always like turnover, not a whole lot, but there will be turnover in the top 500 as there's competition that involves in, comes into the market and stuff like that. So the S&P 500 has been used to measure the performance of the US market, right? Like I said, since the 1920s. The S&P 500 from 1957 until 2022 has been a return of 11.8%, near 12%. Now, a lot of people call the S&P 500, which would be like an ETF, like VOO would be a good example, or you could even have an index fund through Fidelity FXAIX, something like that, where this is an S&P 500 fund. It tracks the index and it just basically mirrors what the top 500 US companies do. A 12% return is supposedly boring in today's world, but I'm going to give you some numbers. So if you had $100,000 during this time frame and you received a 12% return, well, really 11.8% return to be exact, and you were investing $1,500 during that time with $100,000 to start, and you did this for 20 years, you would have $2.5 million. I don't know. That's not boring. So there needs to be the facts stated, and it's specifically around not only long-term goals, but that index and ETF investing is not in any way, shape, or form boring. However, the reason we talk about being boring as investors is because we don't want to do a bunch of activity. Because the more activity you do, the more activity you create, the lesser result you get. That's statistically proven. And that is on the fund level. When you have a mutual fund manager that's running a fund and actually trading in and out actively managed mutual funds, which I talk about a lot, or the day trader in their mom's basement that is telling you and screenshotting their wins of 1 in 14,000, wins that they have. They all really have like 14,000 losses, but they have that one win and they want to post it, or they can literally just screenshot in Photoshop, by the way. I've seen people do that. So be careful. So anyways, with that being said, in 2024, the S&P had a return of 23%, and I lived that, and I had a lot of millions invested. And because of that, if you do the math, $1 million sitting there, 23% returns, specifically 23.31%, would be $233,000, $100 specifically on the end, to get to, you would be earning that during that time period in 1 year if you had $1 million invested. Times that by 2 if you had 2 million. Times that by 3 if you had 3 million. Get my point? That's what we did. Actually did. So we did it the fundamental way. And those are huge returns. We're talking $600,000-$700,000 returns in 1 year. That's not boring. Get your capital invested and let it sit for a long period of time. Let's dollar cost average into index funds and ETFs. That's the way to actually build real wealth. And you're not going to lose a bunch of money, because I'm going to share statistics that's going to really, really scare you in this situation. And it's for good reason. Well, first off, there's so much to shed light on, but the average individual investor underperforms the market index by 1.5% per year. So let's just say that average investor decided to perform at his own level during the same exact time frame. So 11.8 minus 1.5 would be 10.3 if I can do correct math. And we would get a number in a figure of 1.9 million. Looks good, generally speaking, but we're missing out on $500,000 of gains during that period because we want to be the average investor, which is really, really sad. The active traders, though, however, underperformed by 6.5%. So if we do the math, 11.8% minus, I'm going to do this math on my computer because I'm not that smart. 11.8 minus, we're talking 6.5%. We're looking at a 5.3% return. And if I do the same exact example, so $100,000 invested, $1,500 invested per month after that for 20 years at 5.3%, we're ending with $900,000. It's like a $1.6 million difference we're talking about with the average trader. So your average trader that's making money on a Discord, getting subscription revenue, that's not making money on trading, is lying to you. And I'm here to tell you the truth with the actual data and numbers in front of me. So not only that, but the average investor doesn't have to deal with all of the losses that traders are going to lock in. When you are an investor that you buy and hold low-cost index funds and ETFs, you aren't losing money until you actually hit the sell button, which traders are doing often. If I bring into the tax side of things, which I don't think a trader is going to understand the tax impact, but I think a CPA would, that is very costly, because when you make that move, that trade to lock in, if you have a gain, what they don't tell you is the capital gain impact of that move. Trading is a short-term in nature type of thing. Therefore, it's typically less than a year. And therefore, that activity that they decided to lock in that gain on is being taxed at their ordinary income tax rate versus a 15% tax rate if they bought and held. So let's just say they're a 24% tax bracket and they make a sell and they make a gain of $100. They really net after taxes of 24%, $76. That's not as good as they post online. And if they would have held for a longer period of time, not only would they get a better gain, more compound interest, but their tax rate would have went from 24% to likely 15%, assuming capital gains tax rates are what they are today, which would have been a 9% decrease in taxes. When you're adding 9% differences, $900 doesn't sound like a lot, but that you add that zero, it's $9,000 difference. You add another zero, where the level I'm at right now, you're talking $90,000 differences because of taxes. They don't tell you that. But of course they don't, because then they want to get you in their Discord and get your subscription revenue. But I'm here to tell you the truth. Traders with up to a negative 10-year track record typically continue to trade. And that's really, really sad, because they don't even look at this clear data in front of them of what they're actually doing, because they're always trying to get rich quick and they never get rich quick, which is kind of ironic. I don't know why they don't get this picture. But let's look at some more data. So below are the actual amounts that you have to gain to recover from losses. So let's say you have a negative 10% loss. You lock it in. In order to get that back, most people would go and default to, well, you need 10% to gain it back. Not true. You need 11.11%. I'm going to jump down to negative 50% because that's a reality for a lot of traders. If you lose negative 50%, you actually have to gain 100% back to be at your same spot. If you lose 90%, you have to gain 900% to come back. You're not going to do that. This is why people lose. They get themselves in holes and they never can recover financially. And they're betting on something that basically works out for 1% of people, or let me say algorithms, the billion-dollar algorithms on Wall Street that are actually making the real money. These are computerized algorithms that are actually saying when to buy and sell based on data input from a human, and they are making real-time moves. A human cannot do that and cannot keep up with that type of level of AI, essentially. Here's some really good statistics as well on top of this, because I love to make fun of traders for good reason, because they're selling you a pipe dream, and I'm not here to sell you a pipe dream. I'm showing you how to get actually wealthy with real fundamental principles that last a lifetime, that are timeless, that are talked about by all the biggest experts in the world. Only 13% of day traders maintain consistent profitability over 6 months. It's not good odds at all. 72% of day traders end the year with financial losses. I don't know. If I know 3 and 4 people every year are going to lose, I'm probably not going to take my chances. 40% of day traders quit. Why would they quit if they always win? Within a month. And then the ones that continue, that sell you the subscription, will say, well, you have to have the mentality to trade. You have to have the right, um, mindset to trade. And, of course those people are gonna quit, and they're gonna sell you on this pipe dream, and they're gonna continue down the same path they always do, which is lie. 80% of day traders quit within the first 2 years. So 8 out of 10 of us, if we lined up and started day trading today, would openly decide to quit within 2 years. 90% of traders lose 90% of their money in 90 days, the 90-90-90 rule. That's extremely concerning, and I don't know why anybody would sign up for that if they knew what they were getting themselves into. But of course you don't, because you see all the wins. And so these are the real facts behind day trading, which is why I destroy anybody that promotes this unethical behavior, because it's not going to work for you. You're going to lose money. And again, like I said, only 1% of day traders over 5 years actually make money. I'm going to also do a parallel here, a parallel argument, that is, to understand why activity in the markets is detrimental. So when you make and buy and sell and do all these types of moves in the market, not only are you not gaining the compound interest that you would if you were to sit there for a long period of time and let the market do its thing in dollar cost average. So as the market dips, you automatically take advantage of that. Somebody that's a fund manager, a mutual fund manager, they have a mutual fund. They're running it. The goal obviously is to beat the S&P 500, right? This is, again, not a day trader. This is a true mutual fund manager. There is also data to suggest that over a 20-year period, 95% of mutual fund managers, which are active professionals that study this and live this and breathe this every single day, have a 5% chance of success to beat the market over a 20-year period. And honestly, here's the other thing that no one tells you about the statistics as well. During that 20-year period, they're going to be trailing index without question a lot of the time, because they won't just outpace it by the whole entire time. There will be ups and downs. So for the average individual that's getting into this world, that wants to get an actively managed mutual fund or day trade, let's just say they're like, hey, this is the actively managed mutual fund over the next 20 years that's going to beat the market. There's called behavior psychology and finance that nobody talks about, but there's a reason Budget Dog Academy folks do talk about this. There's a reason my Budget Dog Academy students go through and speak with a behavioral psychologist, because this is destroying your finances if you don't understand your psychology, your subconscious, all the stuff that actually makes you do what you do. All of your experiences, all your how you grew up, where you came from, all that stuff plays a role in how you act with finance. And so when we talk about this, there's good reason. But let's say you take a bet on one of these actively managed mutual funds today in 2025, and you say, okay, in 2045, I bet that this is the 5% of funds in the group of 5% of funds that beat the S&P 500. During that time frame, that fund will be losing to the market. Will you have the conviction to stay put? Especially when you see me talking about how most of them don't win. You might go through a recession. You might lose a job. There might be real life that happens to you. You might lose a house like we did with our mold and mycotoxins that was extremely unpredictable. And so there's a lot of things that are going to tell you to sell out during that 20-year time frame, even if that actual fund does win, which is very interesting, because the psychology is that while 5% of actively managed mutual funds do win or beat the S&P, which is still a very small percentage, what are the percentage of people that hold those funds the whole time actually see that success rate? It dwindles to like less than 1%. So when you see this from a top-down approach, you see the data to back it, and you wonder why every time this conversation comes up of what stock do I pick, or how do I trade, or where do I get started, and they think they need to trade, you see why I get a little heated, because I have all this data in my head stored from 13 years of real life experience and actually using this on a day-to-day basis with real people, getting them real results, building their net worth hundreds of thousands to millions of dollars over a small time frame, doing it the fundamental way, doing it the way I talk about in Budget Dog Academy. Literally, I give them the exact roadmap. The roadmap to financial freedom also talks about the fundamental ways of building wealth. And when you start to apply those real wealth building strategies for a long period of time, you're actually going to start to win. But if you keep falling victim to all the day traders online, which there will be a lot of, because there's a lot of uneducated individuals, best of luck. You know the data. So if you decide to do this with knowing this data, you're not a real smart individual. Most people are doing this because they don't know. But if you listen to this podcast today and you understand the data that comes with it, you know that's the silliest thing in the world to do. And you're wanting to get the result of your financial future, which is usually financial freedom to some extent, which looks different for everybody. And if you want to do that, do it the fundamental way, and you can actually speed this up pretty quickly. Like I said, the example I used on my phone today, these are real actual numbers. So if you had $100,000 and you were investing $1,500 per month, and you had the actual real return of the S&P 500, which again, we want to diversify a little bit here, but just actual returns from 1957 to 2022, 11.8% return would get you $2.5 million over 20 years. That's hard to beat. You're close to financial freedom at that level because that generates $100,000 in passive income if you start to withdraw that at the 4% rate, which is unbeatable. And there's actually even talks from the person that created the 4% rule, for anybody that knows that he's actually now comfortable with a 5% withdrawal rate, which would mean more money from that $2.5 million. And if you did 5% specifically of 2.5 million, let's call it, it would be specifically $125,000 per year, which is even more, technically speaking. Not to say that's the way to go, but he has come out and said that he does support 5% rule. So with that being said, I want to protect you. I want to educate you. I want to make sure that you choose the right route for you and your family. I want you to actually get real results. And the reason my students get real results, and you actually see those publicly, and they actually sit there and, they don't just come and go with a quick screenshot of one win or a photoshopped win. They're actually families out there that are, in the ages of 25 to 50 years old, with kids, with jobs, with one spouse wanting to stay at home, with a bunch of debt on their hands, not knowing how to invest, just wanting to get started, having a bunch of cash on the sideline, losing a lot of money to inflation, and they just want to get started. And they just want real financial results. And it doesn't come from day trading. It comes from real fundamental financial wealth building habits. And when you implement this automated financial system in your life, which you can book a call with my team below in the show notes, this is when you're going to start to win. When you take action and you change and you stop chasing the get rich quick thing that never actually gets you rich quick. It always keeps you poor. Let's change that today, guys. And I hope to see you guys next week.
You've been listening to Money on My Mind with your host, Brennan Schlagbaum. If you found value in today's discussion, share it with someone who could benefit from it too. Be sure to subscribe to the podcast if you haven't already, so you never miss a money mastery tip. Until next time, stay passionate about your financial journey and keep taking bold steps towards your money goals.